Okay, Bismillahirrahmanirrahim. Let's start with the today's session. And today, what we are going to do, we are going to practice for the consolidation question. And the question that we are going to start is the past paper question, which is related to the consolidated statement of financial position. And let's see that what is the data and requirement that is given in that particular question. But before we start, please do remember one thing, that whenever you are having a consolidation question, or whenever you are having a question that is related to section C, whether it could be a final account question, consolidation, or ratios, please try to understand this one, that there will be a question, and this is the professional exam, that is an ACCA. And please do remember, this will never be the case will be able to get the whole question. Yes, please mark my words. This will never be the case that you will say that I know each and everything in that particular question, and the question is 100%. That I know each and everything in that particular question. This will never be the case. This will never be the case. Please try to understand this one. This is the professional exam, and there will always be something that you might not know. There will always be some adjustment that you will might not be able to understand. But remember, this can never happen that you say that I don't know anything in this particular question. I will read out this particular question. This is one of the last or the recent attempts question. I will read out that question, and you will see that there will be many adjustments that you will say that okay, perfectly fine, I know the treatment of that particular adjustment, I know the treatment of that adjustment. But yes, there might be one or two adjustment that there will be a trouble, or you might not be able to link that adjustment. What you have to do, you have to give best towards that particular adjustment. Nothing to worry about this one. Examiner knows that you will not be able to attempt the 100% question. So it means you have to try, and you have to give your 100% efforts, and you have to give your best. And out of 18, if you can see on your screen, that there are 20, that is the 20 marks question, in which 18 marks is the requirement for consolidated statement of financial position. It means there are multiple adjustments. And for instance, if God forbid you will not be able to attempt any adjustment correctly, if you will not be able to counter or adjust any adjustment correctly, so obviously examiner will not be deducting whole marks. Examiner will not be rewarding you 0 out of 18. There will be few marks adjustment, and definitely you will get the rest of the marks. So please don't panic while attempting the question of consolidation, final account, and ratios, especially while you are practicing. If you are practicing, and if you came through an adjustment, that you were not able to catch it, or that you will not able to link it, so nothing to worry about it. It's a blessing. You just upgrade your dictionary, that okay, if this particular is there, if this particular adjustment is there, so it means the treatment or the effect of this adjustment will be on this and this. So it means you have upgraded your knowledge. So please try to upgrade your knowledge while you are practicing for section C questions. So please stay motivated. Don't demotivate yourself, and try to bring some positive vibes. Now here we are going to start the question. First of all, let's read out the question and see that what is the requirement of that particular question. First of all, I'm solving this question on a practice platform, and please remember that you have to practice for your exams on this particular practice platform. At the end of the session, I will also show you the past paper questions that is available on this practice platform. I will also show you the pre June, September, or March mock exams. I will also show you the FR practice exam 1 and 2 and specimen. So I will show you at the end that how this resources can be availed. So first of all, let's read out the question without wasting the time. So this scenario relates to two requirements. Number one, first of all, on 1st of July 2009, on 1st of July 2009, 1st of July 2009, Paisley Company paid $100 million in cash to acquire 80% of the Scottish, which means that Paisley Company is a parent company, and Scottish Company is a subsidiary company. And 80% is the acquisition, so which means 20% is NCI. By the way, the subsidiary was acquired on 1st of July. And if you can see the date of reporting, okay, my God, it's 31st of December 2009, which means that it is the mid-year acquisition question. Yes, it's a mid-year acquisition question. And remember, I told you while we were practicing for mid-year acquisition that whenever there will be a mid-year acquisition, the only adjustment that you need to make is for to calculate the retained earning at the date of acquisition. That will not be given in the question. That will never be given in the question. So please try to remember that it's a mid-year acquisition question, and it means that if it is a mid-year acquisition, so mid-year acquisition question, retained earning at the date of acquisition will never be given in the question. Okay, now the statement of financial position is there, that a property, plant and equipment, investment, inventory, receivable, cash. Okay, perfectly fine. So balance sheet seems like very normal. Now there are following adjustment. Now let's read out the adjustment. Number one, the fair value of the Scottish net assets were equal to their carrying amount. It means that the subsidiaries fair value of the net assets is equal to the carrying amount with the exception of its head office. Okay, it means all the assets are recorded at its market value, exception of the head office. They had this had a fair value of 12 million in excess of 12 million, a fair value 12 million in excess of carrying amount. Now, what is this? This is basically the revaluation surplus. Yes, this is basically the revaluation surplus at the date of acquisition, and this at the remaining useful life of 10 years. Now, if you remember, there is nothing new in this adjustment. We have already done it. We have already done this adjustment, this kind of adjustment in our practice sessions, that the revaluation surplus, it means the net assets adjustment is given over here at the date of acquisition, and the remaining life of that asset, is also given. So it means we are going to calculate the fair value depreciation, if you could recall. It means that subsidiary companies' net assets were understated. It means the subsidiary companies' net assets were the subsidiaries companies' assets. The subsidiaries companies' head office is understated, which means the depreciation is also understated. So it means we need to account for the depreciation expense as well. Okay. So it means it seems like the first adjustment is quite simple. There is nothing new in this particular. I told you you can't say this that I don't know and I don't know anything. I couldn't understand anything in this question. This is not possible. This is not possible. It means you are a liar. You can't say this one. This is not possible that you will say that I don't know anything in this question. I couldn't understand anything in this question. No, this can't happen. There could be one or two adjustments that you might not be able to understand, or you might not be able to grip, or you might not be able to account it for. But remember, majority of the question you will be able to pick up to attempt it. Now, second adjustment on 1st July 2009, which means on the same date. On the same date, yes, on the same date. On 1st July 2009, Besley Company acquired 40% of Angus. Okay, guys, it means that there is also an associate company. There is also an associate company. Besley Company acquired $30 million in cash. Now, what is that $30 million? $30 million is basically the investment in associate. In addition to this, okay, this is not the end. Besley Company issued previous owner, which means that parent company is issuing to the previous owner of Angus. It means from which they have bought the shares of previous owner of Angus Company 30 million shares in Besley Company. It means that uh, in addition to the cash consideration, Besley Company has also issued ordinary shares of 30 million shares, which had a market value of 2.30, which had a market value of 2.30 at 1st July, that is at the date of acquisition. It means that parent company has made an investment, and the investment in associate can be calculated by cash consideration as well as the share exchange. The total consideration exceeds the group share of Angus net assets. Besley Company has only recorded. Okay, this line which is given over here is not relevant. There is nothing to do with that one. That total consideration is greater than the group share of Angus. Okay, perfectly fine. I don't have to do something from that particular sentence. Yes, the important line is the company, Besley Company, has only recorded the cash consideration. The Besley Company has recorded only the cash consideration, which means the share exchange is not yet recorded. Share exchange is not yet recorded. Now, second statement seems to be very fine. In this particular adjustment, it's focusing more on the investment in associate, which means that here the investment in associate will be calculated. How it will be calculated, we'll look into that one. Third adjustment, Scottish, that is a subsidiary company. Subsidiary company made a loss of $10 million for the year ended 31st December 2009. And Angus company made a profit of $6 million for the same period. It means that is both are the total profit for the year, total profit or loss for the year. So Paisley company's total loss, your net loss for the year is $10 million, and Scottish company's profit for the year is that is $6 million. $6 million. Now, adjustment 4. Paisley Company and Scottish both hold other equity investment. Other equity investment means that is IFRS 9. It means they have also hold the other equity investment. No election has been made to classify them as fair value through OCI. It means that company is not using the fair value through OCI. The company is not using the fair value through OCI. Instead, the company is using the fair value through PNL. So at 31st December, no election has been made to classify the fair value through OCI, which means that in equity investment, if you're making an investment in the equity, which means that what will happen, that we will uh, if the fair value through OCI is not used, so it means the fair value through PNL will be used. Fair value through PNL will be used. It is it is written very clearly that no election has been made to classify as fair value through OCI. So it means fair value through PNL will be used. At 31st December 2009, these have increased by $5 million and $3 million respectively, but no entries have been made to reflect this, which means that the increase in the fair value by 15,000 and 3,000 has not yet been recorded. 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 It means that we have to record it. And remember, the gain of particular fair value through PNL will be recognized in PNL. Fifth adjustment, Scottish and Angus have both sold goods to Paisley Company for many years. It means subsidiary and associate both are having an intra transaction with the parent. None of these goods, that is the very good news. None of these goods remain in the group at 31st December 2009. So the Scottish and Anglo company sold goods to Paisley, that is the parent company, but no goods have been stocked out. No goods are remain in the inventory, which means if there is no goods that is left out in the inventory, which means that the unrealized profit is zero. There is no unrealized profit because all of these goods are sold. Either it is received from the parent or associate. Paisley Company's financial statement shows a 5 million payable to Scottish, which means it's a payable of a parent company. Payable of a parent company. This disagreed with the amount of receivable in the financial statement of a Scottish company due to 2 million payment made by Paisley Company. Please do remember that there was a difference, and it is stated that this disagreed with the amount of receivable in the financial statement of a Scottish due to a 1 million paid by Paisley, which means that Paisley has made the payment, but right now Scottish didn't receive the amount. So 5 million is payable to Scottish, and this disagreed with the receivable, and the intra cash in transit is basically 2 million, and then after 2 million, there will be a set off of receivable and payable. Sixth and the last adjustment. Paisley Company values the non-controlling interest using the fair value method. At 1st July, the fair value was measured at $29 million. $29 million. So these are the adjustment, and you can't say that I don't know the accounting treatment of all of these adjustment. No, the last adjustment is quite simple. The fifth adjustment is quite simple. It's a cash in transit. Third adjustment is quite simple. There is information that there is a parent loss. Sorry, there is a subsidiaries loss and associate is in profit of 6 million. Second adjustment, it's talking about the investment in associate. It means there we have to calculate the investment in associate. And the first adjustment, that is the fair value of Scottish net assets were equal to, that is, it's a net assets revaluation surplus that we need to account it for. So what we have done, we have read out the whole question, and now what we are going to do to fulfill the requirements. Now, what is the requirement? Prepare the consolidated statement of financial position of the Paisley Group. It means we need to prepare the consolidated accounts. We need to prepare the consolidated accounts. That is a consolidated statement of financial position for 18 marks. And the second treatment is basically a theoretical part. We'll look into that one. But first of all, let's try to solve the first situation. Now, how we are going to solve it? That is the response area in the below area. What you can do, you can just minimize or you can just squeeze the question area, and you can definitely enhance your response area so that you can answer it properly. Remember, this is basically the front side. You can see the screen. The main answer should be over here, and the right side, that is the right side, will be used for working area. So we are going to prepare the consolidated statement of financial position. But before we move on, first of all, obviously, we have to work out, we have to do working for the consolidated statement of financial position. And if you remember, NL, whenever it is required to prepare the consolidated statement of financial position, the first task that we need to perform is to calculate, yes.
You close one eye, think
Ah,
of
yes.
goodwill, and calculate the amount.
Close one eye and calculate the goodwill. Think about the goodwill, right? But before the calculation of goodwill, sometimes the goods are sold by parent to subsidiary or by subsidiary to parent. So for that, you need to take in onto board that whether there is unrealized profit or not. If there is unrealized profit, so first we will calculate the unrealized profit. But so far here it was written that no goods are left in inventory. You can see the paragraph. You can see the paragraph where it is. Here we go. The Scottish and Angus both sold goods to Paisley for many years. None of these goods remained in the inventory, which means that there is no unsold goods. And if there is no unsold goods, it means there is no unrealized profit. No unrealized profit. Now what we have to do? But yes, the Paisley Company statement shows the $5 million payable to Scottish, which means that parent has a payable of 5 million, and obviously Scottish should have a receivable of 5 million. But here it says that this is disagreed with the receivable of Scottish. Why? Due to a $2 million payment made by Paisley, which means that Paisley has already made the payment, which means the total payable was 7 million. Now it is left out by 5 million. The total payment was 7 million and 2 million was paid by the parent company. Now we will assume, let's try to make an entry for this one. We will assume that this cash is received. That is the cash debit and accounts receivable will be credited, and this will be done by 2 million, that is 2000. It means that there was a cash in transit of 2 million. Why? Because 2 million was dispatched by the parent company, but it is not yet received by the Scottish company. So we'll make an adjustment for cash debit and account receivable credit. Now, once it is done, which means that now the receivable balance and the payable balance of both the company is equal. So if the receivable and payable or both the balances are equal. Both the balances are equal. Now we are going to set off. We are going to cancel it out. Account payable debit and account receivable will be credited with the amount of 5,000. So account payable debit and account receivable credit. So what we have done, we have calculated the most easiest part. Now moving on towards the goodwill. Now how the goodwill will be calculated, that is the investment. So let's see the investment in Scottish. It was written in the question at the very start. That is, it is $100 million in cash. $100 million in cash. Now one more thing, that we have calculated the investment. Now we are going to add the fair value of NCI at acquisition. So the fair value of NCI at the date of acquisition is already given in the question, and that was 29 million. That was 29 million, which means that was 29,000. Now you can see that few of the adjustment that we've already accounted for, and if you see just that this fifth adjustment is completely taken into account, completely taken into account. And once we have incorporated the fair value of NCI at the date of acquisition, this is also cancelled out. Now what we have to do, we need to less or deduct the fair value of net assets of, so the fair value of net assets, fair value of net assets of Scottish at acquisition. Now we have to calculate the net assets of a subsidiary company. For that, we will be moving on towards the working two. And the working two name is, that is the net assets of Scottish, and we are going to work out in three columns, that is at reporting, at acquisition, and post. And first of all, we are going to add the share capital. Now, share capital at the date of reporting. Share capital at the date of reporting. That is given in the question. Share capital at the date of reporting of a Scottish company. That is 40,000. So 40,000. This will also be reported at the date of acquisition. And if you just calculate the difference of it, now the second thing that we need to do, we have incorporated the share capital, Now, one more thing that we need to account it for. That is, what do we mean by net assets? Net assets means that is the capital and reserves. And remember, do remember that retained earning is the reserve, revaluation surplus is the reserve. So these are all known as what the reserves. Okay. Now, if you just move on. So first of all, there was a fair value adjustment. We have written down the share capital, but there is no share premium right now. But what happened over here? That we have a fair value adjustment. That is the revaluation surplus. So the revaluation surplus at the date of reporting. Fair value at the date of acquisition, that is the revaluation surplus, was 12,000. That is the share capital, and then we have revaluation surplus. Share capital, and then we have revaluation surplus. Now, one more thing. Uh, Now we are going to record the retained earning, and retained earning at the date of reporting. Retained earning at the date of reporting is 81,700. And retained earning at the date of acquisition, this will not be given in the question. I told you, because it's a mid-year acquisition question. It's a mid-year acquisition question. It means you have to work out how we are going to calculate it. First of all, mid-year acquisition. It was acquired on 1st of July, and the accounting period is 31st December. That is post acquisition month is 6. Now the retained earning closing balance is already given in the question, and the retained earning closing balance is given in the question, that is 81,700. That is the retained earning closing balance. Now we need, if you are starting with the retained earning closing balance, so we have to work out, we have to work back. And if you are having a work back condition, so what we are going to do? What we are going to do? From the date of reporting, we want to revert back, and we want the date of acquisition. So it means that we are going to deduct the post acquisition profit. That is the acquisition profit, post acquisition profit of 6 months. Now, how we are going to calculate the 6 months profit? Here, the good news is that the Scottish company made a loss of $10 million. Okay, which means that $10 million is basically the loss for the year. Right now, Angus information is not required, but subsidiary made a loss of $10 million. What we have to do? What we have to do? That 81,700 is the retained earning. We need to go back. We need to go back. So it means we are going to deduct it, and we are going to deduct. I'm taking the minus sign again. Just look at this very carefully. Minus 10,000. Minus 10,000. So 81,000 is the retained earning closing balance, and minus post acquisition. Post acquisition months. But remember, this 10,000 is for the year. So now 86,700 is the retained earning. 86,700 is the retained earning at the date of acquisition. Now, one more thing. If you have recognized the revaluation surplus, so it means we need to adjust this one. That is, the fair value depreciation will also be recorded. And this will be reported in the reporting column only. This will be reported in the reporting column only. Yes, this will be reported in the reporting column only. How it will be reported? That the revaluation surplus was $12,000 divided by 10, and remember it's a mid-year acquisition, so it means multiply by 6 and divided by 12. So this will make 600, and if it is the depreciation, so it means that it will be from the minus sign, it will be with the minus sign, because the retained earning of a subsidiary is overstated. There was no adjustment. Now we have accounted for the fair value depreciation as well. So it means the first adjustment, more or less, we have already accounted. We have accounted for the first adjustment, that is the fair value along with the fair value depreciation. Now what we have to do? Just look at that if there is any fair value adjustment or not. Here it says in the second paragraph that there is an associate company, there is investment in associate. The data is related to investment in associate. Okay, now third adjustment, made a loss of $10 million. We have already accounted for that. Subsidiary company made a loss of $10 million. Now fourth point, Paisley Company and Scottish Company both hold other equity investment. It means that is investment in equity, and company is using the fair value through P&L, and it means that if there will be any investment appraisal, so this investment appraisal will be recorded in the P&L. At 31st December 2009, these have increased by 15,000 and 3,000 respectively. It means that the fair value gain or the investment value will increase by 15 million of a parent company and 3 million for a subsidiary company. But no entries have been made in this regard. All these gains have to be made as a post acquisition period. Yes, it says that any gain that will arise from this investment will be the post acquisition profit. If it is the post acquisition profit, so it will become the part of your consolidated statement of financial position. Now there is a gain of 15 million for parent. It means the value of investment is increased. If I just make an accounting entry for this one, that if there is a gain, so it means that investment, so the investment was 100,000, and if there is a gain, so it means that fair value gain will be credited. So the investment that was made in the fair value through P&L is basically increased by 15,000. That is the investment debit and fair value gain. Please remember, this is not the investment in subsidiary. This is something the other investment. They have bought the shares of some other company, few shares of some other company, and in the same way, the subsidiary company, in the same way, the subsidiary company has also that is 3,000. So it means the investment of a subsidiary company. So investment is debited of S company, and again the fair value gain, that is P&L, will be credited. P&L will be credited. So the investment that will be made is investment debit and fair value gain credit of for P company as well as for the S company. And remember, if there is a gain, so it means that P&L is being credited. And if the P&L is credited, it means that retained earning will be credited. Retained earning will be credited. Please do remember. Same situation is for, so if there is an increase in investment, that is fair value through P&L. So the accounting entry that will be made is investment debit and fair value gain or P&L or retained earning will be credited. And here the retained earning of a P company will be credited. Remember, because it is the gain for the P company. And here the retained earning of S company will be credited because it's a profit, it's a gain for the S company. Yes, I can understand that this might be an adjustment that might tease you. But I told you, you can't say this thing that I don't know anything. It was a simple adjustment, but it could be that you might not be able to catch it. But it says that there was a fair value investment and there's an increase in investment. 15,000 for the parent company and 3,000 for the subsidiary company. So I just made the accounting entry for this one. Now, if you can see that if there is a retained earning of S company, you can see this one. Retained earning of S company. Retained earning of S company is being credited by 3,000. Retained earning of S company. Why? Because there is a fair value gain and that is a post acquisition, which means that this will be adjusted at the date of reporting. So it's a fair value gain. If there had been a fair value gain in the accounts of a subsidiary, so obviously, please remember that subsidiaries retained earning can only be known through net assets, and the gain is 3,000. And at the date of acquisition, so there was no fair value gain. There was no fair value gain. So it means it's zero. At reporting, I've adjusted the fair value gain of 3,000. And this simply will be the part of your post reserve. Anything else that we would like to add up here? So far, what I have done that I have adjusted that particular information. So I've just highlighted as red so that we can understand that this has already been adjusted. Now, so far what we were doing, we were about to calculate the goodwill. So all the adjustment that is required, we have already accounted for here. Now let's try to calculate the total of it. Let's try to, and once we will calculate the total of it, what we will do, we will make the accounting entries related to all those adjustments. So it's 136,100, 138,700, and 2,600 negative. 2,600 negative. So at acquisition, we need the for the calculation of goodwill, we need that acquisition, which is 138,700, which is J23. J23. So I'm going to include it as J23, but this will be by minus sign. Now let's calculate the goodwill. So it's 9,700. Now listen to me very carefully. What happened? That the total investment, if I just calculate the sum, so it was 1,29,000, and the net assets that we have acquired is 138,000. What does it mean? That we have acquired more net assets. So therefore the answer is in negative. And whenever there is answer is negative, you can't say it's goodwill. No, goodwill cannot be negative. So what is that? This is basically known as what? Gain on bargain purchase. This will be known as what? Gain on bargain purchase. This will be known as what? The gain on bargain purchase. Now, what will be the accounting entry? Let me make multiple entries. Let me make multiple entries. First of all, first of all, I'll be making an accounting entry for the revaluation surplus with the amount of 12,000. Revaluation surplus, which means the property, plant, and equipment will be debited, and revaluation surplus with the amount of so property, plant, and equipment debit and revaluation surplus credit. It's 12,000. I guess it's not 15,000. It's 12,000. One more thing that we have done, that is the depreciation adjustment. Depreciation adjustment. Yes, why? Because there is a fair value depreciation of 600. That is for 6 months. 6 months depreciation. So retained earning of S company will be debited by 600, and property, plant, and equipment will be credited by 600. Now, any other adjustment that is in the net assets working, we have recorded the entry for the revaluation surplus for the fair value depreciation. Now we have fair value gain. And for fair value gain, we have already recorded an accounting entry. That is the fair value gain of 15,000 and 3,000. Now, seventh entry that could be made, we have already accounted for all the net assets working. Now, the seventh entry that could be made is for the gain on bargain purchase. Please remember that what will be the treatment for the gain on bargain purchase. Let me write it down over here. That gain on bargain purchase, we will not write down the goodwill in negative. No, we will not write down the goodwill in negative. Instead, this will be treated in P&L. This will be credited to P&L. This will be credited to P&L. With this will be credited to P&L of. This will be credited to P&L of P company. That is the parent company. And thereby, if this will be credited to P&L, thereby it will be credited to retained earning. It will be credited to parents company's retained earning. Please do remember this one. That gain on bargain purchase is basically like another income. And this other income will be credited to parent company's retained earnings. So please do remember. Now the question that you might ask, that what will be the accounting entry for this one? Please do remember, for goodwill and for the gain on bargain purchase, there will not be a specific entry. This is basically a combined entry in which the investment will be credited, share capital of a subsidiary will be debited, reserves of subsidiary will be debited, fair value of NCI will be debited, and there will be a balancing figure that will be credited, known as what? Gain on bargain purchase. So you just need to remember, no need to prepare that compound or the complete entry. Just remember that gain on bargain purchase will be credited to retained earnings. You just need to remember that gain on bargain purchase will be credited to retained earning. That's it. The amount of gain on bargain purchase is 9,700. Now there is no further adjustment of the accounting entry over here. and we have already calculated the goodwill, but unfortunately there was no goodwill. There was the gain on bargain purchase. Now let's move on. Let's move on. And I told you that whenever there is any associate accounting, so it means after calculating the complete goodwill, we are going to calculate the investment in associate, because do remember, the line item will not be consolidated, and the good news is that there is no line item given for the associate company. Only the investment in associate will be calculated for balance sheet, and share of profit in associate will be will be calculated for P&L. Here we are doing the question for the investment in associate consolidated statement of financial position. So we are calculating the investment in associate. How the investment will be calculated? That is investment in associate. Investment at cost. Now, how the investment at cost will be calculated? It was written over here that yes, the Presley company acquired 40% of the Angus and paid $30 million cash. In addition, there is a share exchange. It means that 30,000 is basically 30,000 is basically the cash paid, and it also states that that Pasley company also issued 30 million shares of 2.30 each, which means that is also the consideration. They have issued 30,000 shares multiplied by 2.30. So the total investment at cost is $99,000. And remember, it's written over here that only cash investment is recorded. Cash consideration is recorded, which means that share exchange was not recorded. So let me move on. Let me go fast and let me make an entry for this one. The entry that will be made is investment in associate will be debited, and the share capital will be credited, and the share premium will also be credited. How it will be calculated? That is 30,000 is the shares, and the par value is $1, which is given in the question. You can see in the balance sheet that the par value of both the companies is $1. So it means 30,000 multiplied by 1 is 30,000, and the shares were issued for 2.30 each. So 30,000 multiplied by 2.30. So it's 69,000, and the remaining amount is obviously going to be the share premium. That is 39,000. Remember, the cash consideration was already recorded, but here the share exchange was not recorded in the question. So it means that we are going to record this share exchange in the balance sheet of a P company. In the balance sheet of a P company. Now we were calculating the cost of investment. Now what will be added? There will be five main components. That is the investment at cost, share of post acquisition profit. Third is the unrealized profit, impairment loss, and dividend received. So you just need to memorize it. Now we need the share of post acquisition profit, and the share of post acquisition profit. The associate was also acquired in the mid of the year, and the profit for the year, yes, here we go. Angus profit is 6 million for the same period, but it's a post acquisition. We need post acquisition. That means we need the acquisition. We need the profit for 6 months. We need the profit for these 6 months. So it means that 6,000, that is 6 million, multiply by 6 divided by 12, which means 3,000 is going to be the share of post acquisition profit. 3,000 is going to be the share of post acquisition profit. And remember, this is the post acquisition profit of 3,000. But remember, we need share, and share means that we need 40%. So it means this will be multiplied by multiplied by 40%. So 1200 is going to be the share of post acquisition profit. Other thing that it could be that there could be unrealized profit, URP. There was a condition we have already discussed. There could be impairment loss in investment, but here we have read the question, but there is no as such adjustment given. So let's try to calculate the total of investment in associate. So it's 1000200. Now the fourth working that we are going to perform, we are following the straight procedure that we have done in the practice classes. We are going to calculate the group retained earning. Now how the group retained earning? Before we move on to calculate the group retained earning, first make an accounting entry for the investment in associate. The adjustment that we have made out in the investment in associate. For share of profit and acquisition, the adjusting entry that will be made for this one is investment in associate is debited and group retained earning will be credited with the amount of 1200, and there is no unrealized profit or impairment loss, so no adjustment is required for this one. Now let's move on to working 4, that is a group retained earning, and group means that is a parent retained earning. Now you will see the magic of the entries. You will not be able to forget anything. Parent company's retained earning that is already given, and the parent company's retained earning can be extracted from the balance sheet, which is 214300. Yes, 214300. So it's 214300. Now we need the subsidiaries post acquisition, and this will be taken at 80%. Now the subsidiaries post acquisition is, here we go, 2600, but it's in negative. It's in negative. K23. K23 is a cell number. K23. So K23 in times 80%. So this will make 2080, and this will be negative because it's for the loss. Now anything else? I couldn't remember, so let's see the accounting entries that we have made. If there will be any impact on the parent company retained earning or the group retained earning, so it will be adjusted. In the first entry, no, it will hit the consolidated statement of financial position. In the second entry, investment in P company will be debited, and fair value gain. Yes, oh my God, yes. Here we go. You can see this one, that the fair value gain that is the parent company retained earning will be credited. Yes. So let's put a red mark on this one. So 15,000 will be credited. 15,000 will be credited. It is basically the fair value gain. 15,000 will be credited. It's a fair value gain on investment. That is as per IFRS 9. And the cell number was S10. So it's S10. This will be added up. It's 15,000. Okay. Anything else? Anything else? Is there any other adjustment? Okay. Let's move on. There is a retained earning as will be credited. We have already credited in the net assets working. P company, property, plant and equipment is debited and revaluation surplus is credited. And this is in the books of S company. Okay. This is in the books of S company. So we can just point it out because this was the fair value adjustment. So the parent companies, sorry, subsidiary companies retain earning, we have already debited, we have already accounted for. So let's mark it as with the color so that we can judge that what we have already adjusted and what yet to be adjusted. Okay. Then PP, okay, it will be dealt in the consolidated balance sheet. Gain on bargain purchase, yes, it will be credited in the retained earning of a parent company. by 9,700. It's another income. It's an other income. This will be credited in the parent company's retained earning by 9,700. And we have already calculated this amount, and the amount is in the J9. But this will be added. This will be added. It is basically the gain on bargain purchase. It will be added. Okay, so this is something that we have already accounted for. Let's move on. Investment and associate will be debited. Okay, share capital and share premium of P company will be credited. We'll look into the consolidated balance sheet. Investment and associate debit and group retained earning credit. Here we go. There is another adjustment for the related to the parent company's retained earning. So you can see that there is no need to memorize it. If you have made the accounting entry parallel, so there will be very less possible chance that you will forget anything. So group retained earning will be credited by 1200, and this is basically the share of post acquisition profit of Angus. So let's have a sum for this one. There were no further adjustment, and if you could just calculate the total of it. So it's 238120. That is the group retained earning. That is the group retained earning. Now we are left out with only last working, and that last working is basically the NCI. That is working 5. NCI, that is the non-controlling interest. First of all, the fair value of NCI at acquisition. This is already given in the question. We have taken in the working of goodwill as well. That is 29,000. Then we need the post acquisition. Post acquisition retained earning, but this will be taken at 20%. And it's here. And obviously, it will be in the negative sign. This will be in the negative sign, that is 520. It's 520. Is there any other adjustment for the fair value adjustment? Oh, sorry, for NCI. So let's try to have a recap on the entries. There is no as such entry for the NCI. Neither there is impairment loss for the goodwill. So it means this is the complete working of NCI, and let's have a total for this one. So 288,28480, that is the NCI. 28480, that is the NCI. Now we have calculated we have done with all the workings. Now we are going to consolidate this consolidated statement of financial position. For this, we'll be copying the data. That is, first of all, we need the property, plant, and equipment. Then we have investment, and don't forget that there will be no goodwill. Why? Because that was a negative. If there was a negative goodwill, so it means that will be considered as a gain on bargain purchase, and that was included in the parent company's retained earning. One more thing that we need to make, that is the investment in associate. We'll plot all the values. Any other assets? Yes, we have inventories, and we have receivables. We have cash balance, and then we have total asset. Okay, first of all, complete the asset side. The property, plant, and equipment that was already given, that is 215,000. In addition, 87,000. But this is not the end. We note that there is a revaluation surplus. There is a revaluation surplus. Okay, where it is the revaluation surplus? Here we go. So it will be added up with the property, plant, and equipment will be debited by 12,000. And this is not the end. it will be credited by, or it will be deducted by 600, right? Because there is a depreciation. There is a depreciation. So it means there will be one debit and there will be one credit. Any other property, plant and equipment? No. So it means the total amount of the property, plant and equipment is 313,400. Okay. Let me cancel out the adjustment that we have already made. That is, we have made the property, plant and equipment debited, and so it means these red marked are the adjustments that we have already accounted for, and the unmarked are yet to be accounted for. Okay, let's move on. Let's move on. Then the other adjustment that we have is investment. Okay, in the investment we have 2,97,000 plus subsidiaries investment is 11,000. But remember that investment in a subsidiary company was 100 million. It means 100,000 will be eliminated. And the investment in associate, I'm going to eliminate it. Why? Because I'm going to record the investment in associate with a separate head. That is an updated one. So the cash consideration was already accounted for. It means cash consideration was included, and the cash consideration was 30,000. So I have just deducted that 30,000. So it means that is the remaining investment 1,78,000. But this is not the end. Why? Because there was a revaluation surplus, there was a fair value adjustment, there was a fair value gain, and in both the companies, and it was a post acquisition, so this will be the part of your consolidated financial position. Here we can see the adjustment, that in adjustment 4 it was given that there was an increase by 15 and 3 million. So which means that investment will increase by 15,000 plus 3,000. So this is basically the updated investment, and that is the other investment. This is not the investment in subsidiary, it was eliminated. This is not the investment in associated, it was also eliminated. So the investment in associated is something that we have already calculated, and we can link the share for this one. We can link the cell for this one. Here we go. It's 1000200. Now we have inventories, and for inventories we have 61,300, 61,300 plus we have 22,500. There is no further adjustment. Receivables, yes, 37,100 plus 15,600. And yes, we have also made an adjustment, and that was the cash in transit, in which the receivable was credited by 2,000, and then receivable was again credited by 5,000. So it means the updated receivable we have calculated. So far, we have adjusted the receivable. So let me cancel out that particular entry so that we can closely monitor that what adjustment are yet to be accounted for. So account receivable is credited by 7,000 in aggregate. Okay, we have also debited the investment of P company, right? That was the fair value adjustment. That was the fair value through P&L. That was the as per IFRS 9. So investment we have already debited. Okay. One more thing that is in the entry, investment in associate is also debited. We have also accounted for the investment in associate. We have already accounted for that investment in associate. Now cash. For the cash, the balance is given over here. That is 1,300 plus 9,200, and then we have an adjustment of cash in transit, like 2,000 will be added up. So the total cash is now 12,500. So let's calculate the total of the asset side. So the total of the asset side is 751600. So the total of the asset side is 751600. That is the total assets. Now we need the equity side, and equity side we will having a share capital first. Share capital of the parent company is 270, and we know that the subsidiary share capital will not be entertained, but yes, there was an investment in share exchange, so share capital will also be credited by 30,000. Further, there is no share premium account in the balance sheet, but yes, if the parent company has issued the shares at a premium, so the share premium will also be accounted for with the amount of 39,000. Then we have a group retained earning. Group retained earning that we have already calculated, and the value of group retained earning is 238120. Then we have NCI, that is the non-controlling interest. That is the non-controlling interest, and the non-controlling interest is 28480. Okay. Then we have payables. And the payables that we have is 49,400 plus that's 18,300. And then we have the settlement, that is the 5,000, that is the intra transaction. So it will be minus, or it will be deducted by 5,000. Afterwards we have loan notes, and the loan notes there is 78,000, in addition 5,300. Okay. Let's calculate. Let's see that if there is any unsettled adjustment. If there is any unsettled adjustment, let me try to recap all the entries. Cash is already debited. We have accounted for. Then account payable, it is also adjusted. And then share capital and share premium, we have already adjusted in the equity side. Okay, there is no unsettled item now. There is no unsettled item. Now let's try to total or calculate the total or the sum for the equity side. So it's 7,51,600. So that is the total equities and liabilities. Total equities and liabilities. So that is the total equities and liabilities, which is 7,51,600. So the balance sheet is equal. So this is how you have to attempt. You can see that how I was managing the whole sheet, that I was making an accounting entry, I was preparing the consolidated balance sheet, I was doing the working. So that is something how you have to practice it. Remember that you will practice again and again, so you will be having a very comfort zone on that particular area. This will not be in a very first instance. So once you practice 3, 4, 5, 6 questions, so automatically you will have a very good understanding of that particular topic or area. Please try to practice your questions on that particular practice platform. Yes, you can practice on your normal Excel as well, but my recommendation is please try to practice your questions on that particular modified Excel format, so that you will be convenient, you will be able to solve it in your exams as well. Now one more thing, if you have a time at the end of your exam, you can definitely have a header and footers. You can definitely have the company name, the consolidated estimated financial position as at. So you can definitely have bold, italic, you can highlight few values. So it's up to you if you have a time at the end, so you can do it. Now the second question or the second requirement is explain the rationale behind the elimination of the intra-group balances and unrealized profit in relation to sales made by parent to company, parent to subsidiary. It means the requirement is that what is the rationality why the intra transactions has been eliminated. So you can write the comment over here, and it's just a 2 marks question. It's a 2 marks requirement, so no details are required. You just need to explain in few words or few lines. The main reason why we are eliminating it, because IFRS states that you need to consolidate the financial statements in such a way that it seems like a single economic entity. Yes, consolidate in such a way in such a way that it seems like a single economic entity, single economic entity, that seems like a single economic entity. For this for this for this intra intra transactions should be should be eliminated. And one more reason, moreover, we can also write one more thing, moreover, we need to present we need to present all the transactions and adjustments that is done with outside the group. That is to show the position that is to show the position related to outside the group. Yes, we need to show the position that is against or that is outside the group rather than to show the intra transaction. So it means we show the sales and purchases of that sales that is done to outside the group, that is done to the customers, rather than the sales are made to the subsidiary company or to the parent company. So this is the reason why we have to eliminate the intra transaction, why we have to eliminate the intra transaction and the unrealized profit, the group position can be so that the group position can be known. So this is something that we have done. This is something that we have done, and it was a 20 marks question. And I want say this one, that this was an impossible question. No, this was not an impossible question, but yes, there were few adjustments that might have teased you. But remember, these adjustment has not the ability to demotivate you. These adjustments has not the potential to get you fail in that particular question or in that exam. So please stay motivated while doing the question, and whenever you are practicing, and if you've gone through some adjustment that you were not familiar to earlier, so please try to learn those one and try to upgrade your dictionary and the knowledge. Okay, now one more thing in this session that I would like to do, that I want to give you a brief introduction of this practice platform. That if you have done this question and you will be practicing for the past papers and other question as well, so what you have to do, you need to press this next button. Once you will do this next button, so there will be another question, scroll down the whole page, then you have next button, attempt that question. And once you will attempting that question, so there will be a screen, and you can see on the top, oh sorry, on the bottom left, there is a button that is end exam. You will press it. Yes, yes, and the exam is ended. Now you will move towards exit, and then you will see the interface, and there's a mark, you can see that one. On the top left corner there's a button mark. You will press it, and whatever the paper you have attempted, you will see that here you will find out that paper. Like I have attempted the FR March June 2024 attempt paper. Now I'm going to click on the self mark. Once I'll be clicking on that self mark, so it will be uploading the answer that I have proceed or I have attempted, and it will also give me the suggested or the examiner answer along with the marking scheme. So here it is uploading. Yeah, here it is the question. Here's the question. You can see on the left side, and Here is the answer. You can see on the very center screen, you can see the answer that I have presented. So this is the answer that I have attempted. Now, this will be a self marking. So what you have to do, you just see that, you just see my cursor. There is a question sample answer. Click here, and on this click here, you will click, and once you will click, you will get the suggested answer for both the question, that is the question number one, consolidation, and the question number two, that was the ratios. So you will get the complete solution of it, and that is the examiner suggested answer. So you can compare it, that what you have done right and what there were the mistakes, and you can identify the mistakes. So this is how you can check your answer, that whether you have done it properly or not. So this is how you can rectify or check your answers. So this is one thing that you can do. Number one. Number two, and there are other practice material as well in this practice platform. Let me show you, and you have to practice it. Please try to practice these resources. You can see the tab FR financial reporting. Now there's a blank workspace. First, let me tell you this one. If you are having any question in your notes, in your for example past paper, or very old past paper, or from your booklet, and you want to practice it on that Excel file, so you will be clicking on that blank workspace, and there will be a tab assign. You will click on that assign, and once you will assign, so here you will get this self assigned. Here it is. You can see that the blank workspace is activated. Now you will click on that one, and you will resume with that one. So here it is, the blank workspace. There is no question. The question will be on your hard form. By the way, it is a Word file for the ratios. There could be an Excel file as well. Yes, here we go, the Excel file. Here we go, the Excel file. Here we go, the Excel file. Okay. So here is the Excel file over here. So you can also use that Excel file or the Word file. So here the question one and question two. So you will press the button next and previous. So you can definitely move, and you can have you can solve your question to this platform, so that you have a good understanding of this one. One more thing that I would like to give you an understanding for this one, that is the financial reporting, and you can see the official resource. Now here is the official resource. In this, the past exam library, you will find out the past papers that is only related to section C only. Remember, for section A and B there is no past papers, so there is a section C past papers. Okay. Again, you will assign it, and once you will assign it, it will be on the left side. You can start it, and you can start the question as we have done it today. If I will minimize it, now here it is the practice exam. Practice exam 1, practice exam 2, pre-June 24 exam, pre-September 24 mock exam. So there are 4 exams that are available on your portal. You have to attempt it, and these are the full-fledged questions, full-fledged papers. That is 3 hours paper, section A, B, and C. And in this, once you will end up, you will get the marks for, you will get the checking, you will get the marks for section A and B. Obviously, for section C, you will be self-marking. So it's a 3 hour paper. Definitely, you have to attempt all of these 3 or of these 4 papers. And then finally, you have a specimen exam. That is a FR exam, FR specimen, and definitely you have to attempt that particular exam. That is again a 3 hour paper, and you have to attempt it. By this, if you will be attempting all of these resources, and you will be availing all of these resources, there is no question that you will not be able to ace your exams. There is no question behind it. So please try to avail all of these official resources that have been provided by an ACCA. Are we guys clear on this one?
Clear, clear, sir.
Okay. So this was all from the today's session. I hope that this session was quite beneficial for you guys. Thank you so much, and feel free to ask any question if you have.